G'day and welcome to the Edward Street weekly wrap for the first week of spring. Whilst I love this time of year, the market hasn't proved friendly, with profit taking creating a decent sell-off over the past week. For more, I'll pass you over to Matt.
Thanks, Cameron. Overnight, the Dow Jones finished slightly higher. However, the technology-centric Nasdaq fell close to 1%. Unfortunately, our market is looking at potentially another day in the red, which would be 7 straight down days. So what has caused the market to have this blowout? Well, as with all markets, there are risks and uncertainties, and both have crept higher over the past month. The first is the political landscape. With the uncertainty around a change in government now hanging over the market's head, the market will likely take some risk off the table as Bill Shorten's policies look to target franking credits, which will have an effect on hybrid shares and high yield stocks, and also his policies targeting negative gearing will likely affect housing and bank shares. Secondly, we still have the trade wars persisting, with Trump continuing to increase tariffs on imported goods, creating political tension with the likes of the Chinese. Thirdly, we have the trade wars affecting currencies, and in particular our Aussie dollar, which is now trading just above 71 cents. This will have an impact on the importers, particularly in the retail space, and possibly travel stocks, as the currency makes it less appealing to travel overseas. Finally, we have the end of our reporting season. September is traditionally one of the weaker months, and perhaps this is due to all the catalyst-driven earnings releases from our companies ending in August. Overall, our reporting season did look pretty solid, with plenty of robust results and corporate growth forecast to increase to 7% in 2019. Morgans have identified 3 stocks from the reporting season, being Telstra, Westpac Bank and Link Administration, as their key selections for the year ahead. So how do we play all of this as investors on the market? Well, in the short term, our market is having a small correction, washing out overinflated stocks that have been rising on momentum trading. This is a usual occurrence in the market, particularly after such a strong run. I would caution against trying to pick the bottoms on the way down and wait for the market to actually create a bottom prior to stepping in. If we happen to pull back to 6,000 points, which is about 100 off today, I think you might be able to pick up some good quality names at the bottom end of the ranges. Over to Cameron now for his stock selection of the week.
Thanks, Matt. The stock I'm plugging today is A2 Milk, ticker code A2M. A2 sources, produces and supplies liquid milk, infant formula and other dairy products, including cream and yogurt. A2M distributes its products to Australia, New Zealand, Asia and most notably China, as well as the UK and USA. The sector has remained under pressure with concerns of exporting to China, whereby A2 has proven more resilient. More recently, A2 welcomed new e-commerce laws, as this puts them in a stronger position relative to competition, which hasn't yet established specific certification. Last month, A2 delivered a strong FY18 result with NPAT up 116%, with strong margins and boasts a very good-looking balance sheet. This stock trades on a PEG of 0.9 times for FY19 and FY20, which is an appropriate metric to value a business growing at such a high growth rate. Our analyst has a $12.35 price target and an ad recommendation. A2M recently hit the scales at $10.85, and I'm happy to start accumulating around these levels. Thanks, Matt.
Good on, Cameron. Well, that's the end of another week on our Morgans Edward Street weekly wrap. Please feel free to share this video with friends and family, and don't forget to like us on our Facebook page. Have a great weekend, and we'll see you again soon. Thank you.